Picture this. It is Monday morning. The markets have just opened. You are holding a coffee, looking at your screen. Suddenly, a massive red candle appears on the chart. Silver plunges 4% in a matter of minutes. Gold follows. The news channels are silent, or they are blaming it on interest rates. They are lying. What you are witnessing is not a natural market movement. It is a raid. The Chicago Mercantile Exchange has just executed the kill switch. A quiet notification hits the professional terminals, effective immediately. Initial margin requirements for silver futures are raised by 50%. This means if you held a position on Friday, today you need 50% more cash just to keep it open. If you do not have it, the computer sells your position. Forced liquidation. A cascade of selling that has nothing to do with the value of the metal, and everything to do with the rules of the casino. Welcome to the machine. I am here to walk you through the mechanics of this robbery. I need you to stop what you are doing. Turn off your television. Close the entertainment tabs. Put your phone on silent. You need to understand this mechanism before they trigger it again. But before we dissect the body, I need to know who is witnessing this with me. Where are you watching from? Are you in New York, London, or perhaps Singapore? Let me know in the comments below. Let us cut open the patient and see exactly how this murder was committed. To understand why the price of silver collapsed on Monday, you must first understand the weapon they used. That weapon is called leverage. Most traders in the futures market are not buying silver with full cash. They are borrowing. When you buy a contract for 5,000 ounces of silver on the Chicago Mercantile Exchange, you do not pay for 5,000 ounces. You pay a small deposit. This is called the initial margin. It might be 10%, it might be 5%. This leverage is a gift when the price goes up. It makes you feel like a genius. But it is a loan from the enemy, and the enemy can recall that loan whenever they choose. Here is the mechanism of the crime. On Friday, the market was bullish. The price was climbing. The speculators, the small hedge funds, the retail traders, they were all loaded up on long positions. They were betting the price would go higher. They were using maximum leverage. They felt safe. Then came the weekend. While you were sleeping, the clearinghouse committee met. They looked at the volatility. They looked at the exposure of the big banks, the entities that are short silver, and they decided to change the rules. They issued a notice, margin hike. They raised the initial margin requirement. Let us say it was $10,000 per contract on Friday. On Monday morning, it is suddenly $15,000 per contract. That is a 50% increase in the capital required just to hold the same position. Now, picture the chaos at 8 o'clock in the morning. Thousands of traders wake up to a notification from their broker. It is a margin call. The broker says, you need to deposit $5,000 more cash into your account immediately, right now. If you do not have the cash, we will liquidate you. Most traders do not keep 50% extra cash sitting idle in their accounts. They are fully invested, so they have no choice. They cannot pay the new margin. The broker's computer takes over. This is an algorithm. It has no emotion. It does not care about your technical analysis. It does not care about the fundamental supply shortage. It only knows one thing. The account is under-margined. Sell everything. This is where the forensic evidence becomes undeniable. When thousands of computers simultaneously trigger market sell orders, it creates a vacuum. There are no buyers. Everyone is trying to exit through a door the size of a keyhole. The price does not just fall, it teleports downwards. $1 down, $2 down. As the price drops, it triggers more margin calls for the traders who had a little more cash. As they survived the first wave, but now the lower price has eaten their equity. Now they get the call. Now they are forced to sell. It is a cascade, a chain reaction, a nuclear detonation of paper contracts. And who is on the other side? Who is buying when everyone is forced to sell? The commercials, the bullion banks, the very entities that were short. They are covering their short positions. They are buying back the contracts they sold to you at a high price, now at a rock bottom price. They are not just making a profit, they are wiping out their liabilities. This is not a market correction. A correction happens when buyers and sellers agree on a new lower price. This is a liquidation event. It is a forced transfer of wealth from the leveraged speculators to the capitalized insiders. Look at the open interest data. This is the smoking gun. If this were a real bear market, you would see open interest rising as new sellers enter the market to short the metal. But in a margin hike crash, open interest collapses. Why? Because positions are being destroyed. The players are being removed from the table. They flush the toilet. The weak hands are washed away. The Chicago Mercantile Exchange will tell you this is for risk management. They will say they are protecting the integrity of the clearinghouse. That is the official narrative. But ask yourself this: why do they never raise margins by 50% when the price is crashing? Why do they never make it harder to sell? They only raise margins when the price is rising too fast. They only put speed bumps on the way up, never on the way down. Yeah, they know that leverage is the Achilles heel of the retail trader. They encourage you to use it. They dangle it in front of you. And then, when you are most vulnerable, when you are fully committed, they change the math. This is the backwardation of the rules. Normally, you pay for what you buy. In this casino, you pay for the privilege of holding a bet, and the house can increase the price of that privilege retroactively. So, when you see that vertical red line on the chart, do not panic. Do not think that silver has lost its value. An ounce of silver is still an ounce of silver. It still conducts electricity better than anything else on the periodic table. It is still essential for the Tomahawk cruise missiles and the solar panels. What you are seeing is the price of paper silver being repriced by a rule change. The physical market is a completely different reality. While the paper price crashes on the screen, try to call a dealer and buy a monster box of silver eagles at this new low price. They will laugh at you. They will charge you a premium that erases the entire paper drop. This divergence between the paper price and the physical price is the fracture in the system. The margin hike hides this fracture for a moment. It buys them time. It allows the banks to escape the trap. But it does not solve the problem. The silver is still gone. The vaults are still emptying. This is a game of musical chairs, and the music just stopped for the leveraged players. If you are holding physical metal, you are watching the game from the sidelines. You are safe. But if you are holding a futures contract, you just got mugged in broad daylight by the people who own the street. This is not a glitch. This is a feature. This is legacy code written into the operating system of the financial markets. To understand where we are going, we have to look at the bloodstains on the floor from 1980. Let us open the cold case file of the Hunt brothers. In 1979, Nelson Bunker Hunt and William Herbert Hunt realized that the US dollar was losing value. They started buying silver. They did not buy paper contracts. They bought physical bars. They took delivery. They moved the metal out of the country. By January 1980, they controlled nearly 1/3 of the entire world's supply of silver. The price went parabolic. It hit $50 an ounce. The banks who were short were facing total bankruptcy. The establishment was losing control. So, what did they do? Did they accept the free market? Did they pay the Hunts? No. On January 21st, 1980, the exchange changed the rules. They declared liquidation only. Think about those words. Liquidation only. It meant you could sell silver, but you were forbidden from buying it. Imagine a store where customers are only allowed to return items, but no one is allowed to purchase. What happens to the price? It collapsed, from $50 down to $10. The Hunts were destroyed. The banks were saved. The message was clear. You can play in our casino, but you can never beat the house. Fast forward to May 1st, 2011. Silver was touching $50 again. The same psychological barrier. The banks were short again, and just like clockwork, the margin hikes began. It was a Sunday night. The markets were thin. The CME Group raised margins, not once. They raised margins 5 times in 9 days. 5 times. They hiked the cost of holding a position by 84% in 2 weeks. It was a calculated demolition. The price crashed from $49 down to $33 in a matter of days. The media called it a bubble popping. We call it a controlled demolition. But this time, there is a new variable in the equation. A variable that did not exist in 1980 and was not powerful enough in 2011. The East. While the Western markets in London and New York are playing these paper games, The Shanghai Gold Exchange is playing a different game. They are playing for physical possession. Right now, as the COMEX smashes the paper price with margin hikes, the price of silver in Shanghai is trading at a premium. It is 10% higher than the price in New York. Normally, arbitrageurs would buy low in New York and sell high in Shanghai to close this gap, but they cannot, because there is no metal in New York to ship. The inventories are dangerously low. We are seeing a historic migration of wealth. The paper price is being used to scare Western investors out of their positions, while the East quietly backs up the truck and loads the physical bars. China is importing silver for their solar panels. India is importing silver for their jewelry and industry. They do not care about the margin requirements in Chicago. They are buying the dip. Every time the CME raises margins and crashes the price, they are essentially subsidizing the industrial growth of the East. They are putting silver on sale for the very nations that are challenging the dollar. This is the geopolitical divergence. The West is trading debt. The East is accumulating assets. The margin hike you saw on Monday is a desperate attempt to keep the paper game alive for just a little longer. It is a signal that the physical shortage is becoming critical. They are running out of ammo. In 1980, they changed the rules to save the dollar. In 2011, they changed the rules to save the banks. Now, in 2026, they are changing the rules because they have no other choice. But this time, the buyers are not two brothers from Texas. The buyers are central banks and sovereign nations, and you cannot margin call a sovereign nation. Physics does not care about the Federal Reserve. Physics does not care about the Chicago Mercantile Exchange. And physics certainly does not care about margin requirements. While the bankers are playing games with paper contracts, the industrial world is facing a mathematical impossibility. Silver is the most conductive metal on Earth. It is not just money. It is a strategic element. Without silver, the modern world stops. Let us look at the demand side of the equation. The green energy revolution is built on silver. Every single solar panel requires silver paste. Every electric vehicle requires silver contacts. The average electric car uses twice as much silver as a combustion engine car. In 2025, the solar industry alone consumed nearly 200 million ounces of silver. That is 20% of the entire global supply vanishing into panels on rooftops, never to return to the market. Now add the military demand. We are living in a time of global conflict. Smart bombs, guided missiles, fighter jets, and satellites. They all depend on silver for their guidance systems. The Tomahawk cruise missile contains 15 kilos of silver. When that missile is fired, that silver is gone forever. Do you think the Department of Defense cares about the spot price on the COMEX? Do you think Raytheon or Lockheed Martin stops buying because the margin requirement went up? No. They buy at any price. They must have the physical metal. And this is where the panic sets in for the exchanges. Let us look at the vault data. This is the most critical piece of evidence in our forensic analysis. The COMEX warehouses divide silver into two categories: eligible and registered. Eligible means the silver is just sitting there in storage. It is not for sale. It belongs to someone else. Registered means the silver is available for delivery against a futures contract. This is the inventory that backs the paper price. The registered category is bleeding out. It has dropped to levels we have not seen in decades. There are now more than 300 paper claims for every single ounce of physical silver sitting in the registered vaults. Think about that ratio, 300 to 1. This is a game of musical chairs played with 300 people and only one chair. When the CME raised margins on Monday, they were trying to stop the music. They were trying to force the paper holders to sell their positions so they would never ask for that one chair. They are terrified of a delivery default. If just a small percentage of the contract holders decided to stand for delivery, if they said, "I do not want cash, give me the metal," the COMEX would declare force majeure. They would default. The entire paper scheme would implode instantly. So, the margin hike is a defensive mechanism. It is a desperate attempt to reduce the open interest, to scare away the speculators, and to protect the dwindling physical stockpile. But here is the irony. By crashing the paper price, they are making physical silver cheaper for the industrial buyers. China is watching this price drop and thanking the Western bankers. They are accelerating their purchases. The lower the price goes on the screen, i.e. the faster the physical metal leaves the vaults. They are trapped. If the price goes up, the banks lose billions on their short positions. If the price goes down, the physical metal disappears into the hands of industry and Eastern governments. There is no way out. The deficit is structural. We have been consuming more silver than we mine for 5 consecutive years. You cannot print silver. You cannot tweak an algorithm to create more conductive metal. The margin hike delays the inevitable. It buys them a few more weeks, maybe a few more months. But it cannot change the laws of physics. The shortage is real, and when the industry realizes there is no silver left at any price, the paper market will become irrelevant. So, what happens next? Now that you know the game is rigged, now that you have seen the margin hike weapon in action, how do you survive the coming months? We are looking at 3 potential scenarios based on the forensic data we have just analyzed. Scenario A, the slow bleed. The exchange continues to raise margins incrementally. They hike it by 10% here, 20% there. They keep the paper price suppressed in a range between $28 and $32. This wears out the retail investor. You get bored, you get frustrated. You sell your position and leave. This allows the banks to cover their shorts slowly without triggering a panic. This is their ideal outcome. Scenario B, the liquidation event. A broader market crash drags everything down. If the stock market collapses, margin calls will trigger across all asset classes. Gold and silver will be sold to cover losses in tech stocks. In this scenario, we could see silver revisit $22 or even lower on the paper charts. But here's the catch. The premiums for physical metal will explode to 100%. The paper price will be $20, but you will pay $40 to get a coin in your hand. Scenario C, the decoupling. This is the scenario the banks fear most. The COMEX declares force majeure. They admit they cannot deliver the metal. They settle all contracts in cash. If this happens, the paper market dies instantly. The price of physical silver becomes unobtainium. It goes to triple digits overnight because there is no mechanism to suppress it anymore. So, what is the strategy? How do you position yourself when the house holds all the cards? The answer is simple. Stop playing in their casino. If you are holding leveraged futures contracts, you are renting a position in a burning building. You are exposed to rule changes that can wipe you out in seconds. They can raise margins to 100% if they want to. They can change the rules to liquidation only again. The only winning move is to take possession of the asset. When you hold physical silver, there is no counterparty risk. There is no margin call. There is no algorithm that can force you to sell. You become your own central bank. Do not look at the spot price on your phone. That is a manipulated number generated by a broken algorithm. Look at the weight in your hand. The smart money, the sovereign wealth funds, the central banks of the East, the family offices. They are not buying futures contracts. They are buying bars. They are taking delivery. They are draining the vaults. We are witnessing the end of the paper manipulation era. The math no longer works. The deficits are too large. The demand is too high. The inventory is too low. The margin hike on Monday was a tremor. It was a warning shot. They are telling you that they will do whatever it takes to defend the short position. They are telling you that the system is fragile. Do not wait for the television to tell you it is over. By the time they admit there is a shortage, there will be no silver left to buy. I've compiled a full dossier on the vault drain data and the dealer premiums. It includes the exact chart showing the divergence between East and West. If you want to see the real numbers behind the paper curtain, click the link in the description below. Do not trust the official narrative. Trust the data. Trust the physics. Trust the metal.